Hello and welcome to this video. Today I'm going to be teaching you how to make a technical analysis of a stock. Now, you probably know what a fundamental analysis is. That is when you take a look at the earnings, the debts, and their future prospects. While technicals, we only look at the graph and some indicators, nothing else. So let's take Morgan Stanley here, for example. I prefer to use SMA, simple moving averages with 10, 50, and 200 days averages. That is the blue line here is the 10 days. This is the one that moves the most. 50 days that moves the second most, and then the 200 days which moves the least, of course. And those indicate different signals. For example, right here you can see these red and yellow lines. Now when we have a white line here, that is because the 200-day moving average is higher than the 50-day moving average, which means that the short-term upwards is larger than the short-term upwards, which means that it is moving down short-term. As well as the opposite, which means that when we have a golden line like this, the short-term momentum is higher than the long-term momentum, which means that currently it is trading higher than the long-term. And of course, I use 50 and 200, and those are in days, so 50 days and 200 days. So for example, when we see right here on the September in 24, we see it make a golden cross and then increase quite sharply after that. That often happens because this is a technical signal to buy and it moves upwards. And then we see this golden death cross here right after when the opposite happens and the after a downturn here in the stock price and we see a death cross. So it often is a downwards momentum after the white line, a death cross, and an upwards momentum right after. But sometimes we see them quite close to each other, as you can see here. We have, what is that? Almost a month between these, and then we see it moving downwards and then upwards. That is a great technical signal. And then we have the RSI, which is the Relative Strength Index, and this one has two channels. Now, we have the upper channel here, which is below 70 and above 50. This means upwards momentum. As you can see, once the stock trades over this line down here, it is moving up. If it's below 50 and above 30, it's in the downward trending line and it is moving down. Now, sometimes you see we have spikes and pitfalls, like this is a spike, and as you can see here, that is when the price rises rapidly and then it becomes overbought, which means that buying up here is quite risky, as well as buying down here, the opposite is more often than not a greater choice. As you can see, that is when it falls quite rapidly. Of course, buying down here doesn't mean it has to be great. Of course, if a company just had a poor earnings report, then it might be down here, but it might continue to be down in the lower channel. So don't only trade on this. I often use them together. So if I see a golden cross, I will see, okay, is it overpriced? Let's say it's overpriced up here in 80. I will wait. Chances are it's going to dip maybe to 60, maybe to 50, maybe even below here, as you can see often. When it spikes, it dips below, and then when it dips, it spikes back up. So often, if you think a stock is underpriced and you see it down here, maybe buy it, maybe don't. If you see it up here, maybe sell it. If you wanted to sell it, maybe don't buy it yet. Now those are the two prime factors I use. Now there is something to know about the technical analysis, that when we have gaps in the stock like this, we might see some falls or maybe some irregular crosses, because the technicals only take into account when the candles actually touch each other, or not only, but more often than not, they take each candle into account, and then we lack the candle. As you can see here, we have a gap here, which means that they can't take this into account. On the other hand, over here we have a very long candle right here, as you can see, the red one. Now can take that into the considerations. Now, of course, we see small gaps all the time, but a big gap like this often isn't great either if it's up or down. Now, something we also can use in technical analysis is what is called lines. As you can see right now, we are currently trading at an earlier support line, which is right here. As you can see, let me draw a line here. So let's say, okay, if you think, okay, this stock is going to breach this point and then it's going to keep on rising, it's going to go up here. Or if it's, say it was trading downwards, you would do the opposite. Let's say, look at this, is also right here. We have a support line right down here. And a support line is always based on earlier candle movement or prices. So as you can see, we have a bottom formation here and a bottom formation here. And instead of trading upwards from this point on, instead of trading upwards, we were trading downwards, and we were just about here. Let me just draw a line so it's easier to follow. Let's say we're trading like this instead. Let me just make that another color. Let's make that pink. Let's say we're trading like this instead, just above the support line here. Then say maybe we hit the support line and then we trade upwards. Well, then that would be great, because then we know, okay, most people think it shouldn't break this support line right here. Maybe people think it should be worth more, but the opposite can of course also happen, and we trade downwards. As you can see, maybe we continue through it, and if that happens, we often trade even further down and it become quite rapidly. So that is something that you can also use. Is lines. I use them a lot if I'm going to buy a stock. I see, okay, when is the next line? Is it good? Is it bad? Is it a support level? If the support level is quite far away, I maybe hold on a bit, because that means that there's usually some hype. As you can see, we were trading all the way up here in 141, and the next support line was down here in below 100. We do well. That was no, that was actually wrong. Of course, we'd had one right here. So that's actually great to buy the stock even here. Let's say we didn't have this support level right here, and the first support level was down here. Then you might be thinking, okay, how come we need to fall $40 or almost 40% before the next support level? Is this stock overpriced? Maybe it is, maybe it isn't. But that is something I use those lines for. Now, if you like this video, please don't forget to like and subscribe. And of course, remember, this isn't financial advice. It's purely entertainment and educational purposes.